Hey option traders, for today's trade we're looking at a bullish option play in fast food chain and Dow Jones stock McDonald's. Taking a look on MarketSmith, McDonald's has just crossed back above two key moving averages here at its 50-day and 21-day lines. This is a sign that the stock is regaining institutional support. Recently, shares pulled back and found support at their 200-day line. Since the start of this year, the stock has been trading sideways, building a consolidation with a 271.25 buy point. Shares remain just 4% away from this. Additionally, the retail restaurant industry group has been climbing the ranks and is currently number 16 out of IBD's 197 groups. So given these developments, investors could consider putting on an option play known as a call calendar spread. Calendar spreads are also known as time spreads because they use the same underlying asset and strike price but different expiration dates. This can either be done with two put options or two call options. Remember, with options there are two types, calls and puts. And with both, you can either be a buyer or a seller. Just like with any stock, you can either buy long or sell short. A calendar spread is a low-risk strategy that profits from the passage of time and an increase in implied volatility. So it's best to find stocks that have lower implied volatility relative to the overall market at the time of initiation and profit off an increase in volatility. The call calendar spread strategy works by selling a call option in a near-term expiration cycle and buying a call in a longer-term expiration cycle, both on the same underlying stock. And both options will have the same strike price. Buying the longer-term option and selling the shorter-term option increases capital efficiency, which means that it doesn't require a lot of buying power. Also, more rapid time decay in the short near-term option than the longer-term option is typically how the profit is made on this trade. So let's use an example. Say I'm looking at XYZ stock. Implied volatility is low and I have a slightly bullish assumption. This could be a good time to put on this trade. Say the stock is trading at around $50 a share. To set up this calendar, I'm going to look at buying a call with a 55 strike that has 90 days till expiration and selling a call with a 55 strike that only has 45 days to expiration. You pay a premium of $5 per 100 shares or $500 per option contract for the first call and receive a premium of $300 for the second call. So this trade costs you a net premium of $2 or $200 total, and that would also be the maximum possible loss for this trade. The exact maximum profit potential and break even cannot be calculated due to the differing expiration cycles used. However, the profit potential and break even area can be estimated. Using the prior example, say at expiration of the short-term call option, the stock price is still below the option strike price of 55. Then the short call would expire worthless. If the long call option is worth more than the $200, you'd see a profit in your overall position because you paid $200 upfront for the calendar spread. If the remaining long call is now worth $300, you'd have a net profit of $100. So now that you have a better understanding of the mechanics of this trade, let's take a look at my trading platform and set up a trade. So here we are on my thinkorswim dashboard, and you're going to want to make sure you are looking at MCD. And if you are on thinkorswim, you can select the spread type here in this box, and you're going to want to click calendar. And then you're going to want to look at this expiration date split here, September 16th and September 23rd. And we are looking for the 255 strike price. So to summarize, we're looking to buy one 255 call that expires September 23rd and sell one 255 call that expires September 16th. So for this trade in McDonald's, we're looking at buying the September 23rd 255 call and selling the September 16th 255 call. That results in a net cost for the trade of $95 per spread, and that is the most the trade can lose. The estimated max profit is $200, but that could vary depending on changes in implied volatility. The idea with the trade is that if McDonald's stock remains around 255 for the next week, the sold option will decay at a faster rate than the bought option, allowing the trade to be closed for a profit. The break-even prices for the trade are estimated at around 248 and 262, but these can also change slightly depending on the impact in changes in implied volatility. So for a trade like this, I would set a profit target of around 25%, and I would set a stop loss if McDonald's breaks through either break-even point. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Be sure to check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.